Good day, everyone, and welcome to another accounting video. Now, whether it's wonderful or boring is up to you, but hopefully it helps you learn some of the information that's needed in a basic accounting class. Now, as always, down in the description is a link to this video, so if you want to go down there and grab that video handout, if you're not in my class, that's the best place to get it. Should take you to a file, either Word or PDF, up to you. Today what we're going to look at is the accounting cycle adjusting entries through the closing process. So we're going to record and post the adjusting entries. Then we're going to create an adjusted trial balance. And from an adjusted trial balance, we can produce the financial statements. Now, we're not going to do all the financials. We're just going to do the income statement, the statement of equity, and then the balance sheet. We will not do a statement of cash flows in this series. And then we'll close with the closing the books. So we record and post the closing entries, and we will not do a post-closing trial, but it does exist. All right, so first thing we need to do is understand the company. One, we've got the trial balance. So this is an unadjusted trial balance. So that means they've already done the first 4 steps of the accounting cycle. They've already recorded all the business transactions throughout the year. Now we're at the end of the accounting period, and we just need to make sure everything is properly recorded so that we can produce financial statements. So we got Justice League Internet as of December 31st, 2023. Here's all of our accounts and their balances. Now notice all of these would have already been recorded and posted to the ledger. So if you scroll down to your ledger, notice all those balances are already in our ledger. So we've already got them posted in there. All we need to do is update them for the final adjusting entries for the end of the year to make sure everything is good to go. So let's start there. Based on the adjustment data, analyze and record the adjusting entries as of December 31st of 2023, and then post the transactions to the T account ledger. Again, we're just using T accounts. We're not doing a full ledger in our intro class. It's just simply T accounts so that we can get balances. And I promise we will not do that all the time. It's just this first little unit so that you get comfortable with the process. All right, number 1, deferred revenue still unearned at December 31st is $6,500. So notice, go up to your trial balance. Deferred revenue for the year, we recorded $8,900, but it should only reflect $6,900. So my theory is, when in doubt, draw you out a T account. So I'm going to go right over here, and I'm going to draw myself a lovely T account, a ledger account. And I've got my deferred revenue there, and it's got an $8,900 balance. But what the information tells me is the amount still unearned at the end of the period is $6,500. So that tells me, since it's unearned, that means that's the balance that we have not yet provided to our customer. So we still owe our customer $6,500. Wait a minute, we have 89. So that means we have earned a portion of it this year. So as always, see if you can come up with that number. Pause the video and see what you get. Hopefully you pause the video there and you get 2,400, right? So the difference between the accounts is 24. Well, I've got a credit balance of 89. I need a credit balance of 65. That means I must need to debit my account for 2,400. That means we have earned 2,400 because 65, 75, 85, 89. Get that 4 in there. All right, so if we've earned that, we need to bring the account down, so we know we need to debit deferred revenue. We just found that out in the transaction there. And it doesn't matter if you capitalize both words or not. I'm just, in the habit of doing it. So there we go, 2,400. Now, what does deferred revenue become as we perform the service to our client, as we provide them the goods or the services we owe them? Well, our obligation becomes complete, so therefore we get to recognize service revenue for the company. So we're going to hit our service revenue of $2,400. So what's impacted? Well, deferred revenue is a liability. Do not forget that. We owe people goods or services. So that's not revenue to us. That's a liability to us. So we're going to go over here. Our liabilities here are going down by $2,400. Service revenue is a revenue. That means our revenues are going up by $2,400. And anytime revenues go up, the profit of our company goes up, or at least reduces our loss, one of the two. Anytime income is impacted, so is equity. Notice that direct link there. So our accounting equation, assets equals liabilities plus equity, remains in balance. Our income statement, our income is going up by 24. Statement of cash flow should not be impacted because it is an adjusting entry, and typically speaking, those will never involve cash. All right, next one, prepaid rent. About said insurance. Prepaid rent still in force at December 31st is $1,000. So the amount in force, in other words, the amount that we still have at the end of the year is $1,000. If we go up here and look, notice we had $1,200. Now I'm not going to tee every one of these out, but we have $1,200. We should have $1,000. That means we've consumed $200 of that rent. So what do we need to do? Well, prepaid rent is an asset, so it's a debit. So we need to credit our prepaid rent for the $200. We need to reduce the balance in that account. So we're going to hit prepaid rent for $200. What do prepaids become? Well, assets as we consume them typically become expenses. So it's going to go in and become rent expense for $200. How does that impact our financial position? Well, notice rent expense is an expense. As our expenses go up, what happens to income? You are correct, it goes down. So expenses up, income goes down. What happens to our stockholders' equity? Well, when income drops, so does our equity. Now, what's the offset to that? Well, prepaid rent is an asset, so our assets are also going down. So we can see that direct impact to our financial statements. Again, adjusting entries would not use cash, so no cash flow. All right, supplies used during the year amounts to $500. Now be very careful here. Remember, in the last problem we did, it said supplies on hand at the end of the period. Now this doesn't say on hand. This tells us what we actually used. So we actually used $500. So that means we need to reduce the supplies by $500. Supplies is an asset. So if we use $500, we need to credit supplies for $500. So notice we didn't check the balance. Well, that's okay. We have $900. We don't want the difference. We simply say, hey, we're using $500. We're going to bring that balance down to $400. Now, if it said the supplies on hand were $500, then we would record a $400 decline. So be careful with the wording and how you're looking at supplies. Do you know how much you've used, or do you know how much is on hand? Now, again, supplies is an asset, and as we consume assets, what did we say they become? Very good, expenses. So we're going to go in and we're going to hit supplies expense there for that same $500. How's it impacting our financials? Expenses are going up, so our expense goes up. Expenses go up, our profits go down, so our net income is going to be reduced. Anytime you reduce net income, you also reduce stockholders' equity. And then the offset to that is supplies are going down, so that means our assets are also going down by $500. Again, no cash flow because there's no cash involved in adjusting. Now, I know I'm going through these relatively quick. These are a review of things you've already done. So we just want to get through it so we can finish up the cycle. Depreciation for the year was $300. Now we know depreciation is taken on long-term assets. So we go up here, we only have one, we have equipment. So that means we are depreciating the equipment by $300. Again, it's for the year. We don't have any other information, so we're going to record the full $300. Remember, depreciation is an expense to our company. It's the allocation of cost over the asset's useful life. So we're going to go in and we're going to hit depreciation expense there. Now I'm going to run out of space, so we may have to abbreviate a little bit. And we said that was $300. Now, do I hit the equipment account? Absolutely not. Equipment is carried at its historical cost. So we're going to hit the accumulated depreciation account. Now, I did abbreviate accumulated there simply because I'm not going to have enough room without messing up my formatting. But please, 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 as you're writing this in by hand, put the full accumulated depreciation so you do not get confused there. Accumulated depreciation, again, is a contra asset. It is part of the assets, and the assets are going down because we're crediting them. We're reducing the value, book value of our equipment there. We talked about that in the last video. All right, so depreciation expense is an expense. So our income statement, our expenses are going up, and as expenses go up, income goes down, as we've said a million times now, but repetition is awesome. So income goes down, so does equity, because income is directly related to equity. We'll see that when we do the financials here in a few moments. What else? Well, accumulated depreciation, remember, is a contra asset. So as contra assets go up, overall assets go down, so it's reducing our assets. Again, no cash flow. And finally, for adjustments, we got accrued salaries expense as of December 31st of $400. So our employees have worked for us. We owe them, but we haven't paid them yet. So accrued salaries goes into salaries expense, I think. When in doubt, always check our chart of accounts. So is it salary expense or salaries? It's salaries, it's plural. So go in there, hit salaries expense for $400. Are we paying it? No cash is being moved here, so we owe it. So we owe our employees, so we're going to call those salaries payable for $400. Sometimes companies will use wages if it's hourly. Again, just double check your chart of accounts if you have them. So salaries expense there, and then salaries payable is an account, so we're good to go. How's that impacting our financials? Well, our expenses are going up. So expense up, income goes down. Very good. When income goes down, so does stockholders' equity. So we got to get that in there. Salaries payable is a liability, so our liabilities here are going up. All right, so we have several different adjusting entries there. Now let's go in and split our screen so that we can post all of those to the ledger. So we're going to go through each one of these really quickly and post them to the ledger. Remember, it's a 1-for-1. Debits go on the left, credits go on the right. Deferred revenue, go down to deferred revenue account. Notice that is a debit, so we're going to place a debit in deferred revenue of $2,400. Service revenue is a credit of $2,400. So we're going to go in and credit service revenue $2,400. Rent expense is going to increase by $400, so let's go throw that in there. And then prepaid rent is going to be decreased by $200, so get that in there. Supplies expense. Say the right word; it does help. Supplies expense here, wherever it may be, is going up by $500, so we're debiting supplies for $500, or supplies expense for $500. We're going to go up and we're going to credit our supplies for $500. All right, depreciation expense is $300. So go to depreciation expense. We're going to debit depreciation expense for $300. And we're going to credit accumulated depreciation wherever it's at for $300. Fix my formatting a little bit there. And then last but not least is our salaries expense. So we're going to go to salaries expense. We're adding an additional $400 there. And then on our salaries payable, we're going to go in and we're going to post $400 there. All right, so hopefully I got all those in. Let me remove my list there. Now let's do our balances, and I'm going to actually draw our balances out. Notice during the adjusting process, cash was not involved, and it should not. So what we had to start with, it should remain the same. Accounts receivable can be if we have unrecorded revenues that we have to put in for receivable. In this case, it's not, so $6,500. Now, prepaid rent, we can go in and update prepaid rent. Remember, we said prepaid rent still on hand was $1,000. So we're going to go in and we're going to hit prepaid rent. We see a balance of $1,000. Supplies, let's do the same thing for our supplies. Draw a line here. Supplies, we have an ending balance of $400. Wait, don't know why it's doing some crazy formatting there, so let's try that again. We may have to go up just a little bit, so let's try it up here so that maybe it won't go into our next line. And then 400. There we go. Good enough. Equipment, our depreciation, again, we need to go in and do our depreciation. So we see a balance there in depreciation of $13,100. All right, any others that we need? Yes, our service revenue here. We got to find the balance there, and I get $29,700. And our salaries expense, I'm going to go in and I get $2,500. Our rent expense, we go in and find a balance, and the balance there is $10,200. And then, I forgot deferred revenue. Go in and find a deferred revenue balance, and that should be $65. That's what we're expecting it to be. So we get that in there. And I think that's everything we need a balance for. So again, just go in, find your balances in your account. Now let's split the screen one more time. Once we have our balances, we can go and do our adjusted trial balance as of December 31st. This is all the final balances that we can produce financials off of. Please keep in mind, you do not want a debit and a credit balance. You want just the final balance in the account there. So let me go down here and fix my formatting so everything aligns quite nicely. So in our cash, we ended with $13,000 there. Our accounts receivable were unchanged at $65. Our rent did change. It is now $1,000 instead of $1,200. And our supplies have dropped to $400. Equipment was not touched. It shouldn't be, but we did reduce the value of our equipment through the accumulated depreciation account. So as that increases, the book value, the net of those two accounts right there, will change. All right, accounts payable was not impacted. Salaries payable was impacted by $400. Deferred revenue went down to $65. Common stock should not be impacted, $10.4. Retained earnings will not be impacted until we close the book, so that's still $10.4 there. Dividends, $4,800. We've got our revenues that did change. It's now $29,700. Our salaries expenses went to $2,500. Our rent expense went to $10,200. Our depreciation and our supplies did change. They both increased during the period. All right, so notice how I have final balances. I don't have a debit credit balance. I just have one balance for each account. Now, what I want you to do is pause the video, go through, add up, make sure our debits equal our credits. Hopefully you paused that video and came up with your balances, and you should see hopefully that we have $74,300 as our final balance there for both the debit and the credit side. All right, any questions there? I can't answer them because this is a video, so, good luck with that. But if you're in my class, you can always send me an email. Now, once we have the adjusted trial balance, let's move forward from that. Now we can produce our financial statements. We're going to produce the income statement, just a basic, not a classified. So we're just going to do a basic income, not classified, a multi-step. We're going to do a basic income statement, not a multi-step income statement. We're going to do a statement of equity, or stockholders' equity in this case, and then we'll close out with a balance sheet. We will not do statement of cash flows in our intro class here. All right, so let's start with the income statement. Now, on the income statement, we do want a proper heading. So we've got the Justice League Internet Company here. This is the income statement. Now, the income statement's for a period of time. So this is going to be for the year ended December 31st, 2023, I believe it was. So go up here. Yes, 2023. So we have our beginning. Now, what does the income statement report? Well, it reports revenues and expenses. So let's go ahead and start with our revenues. How many revenues does this company have? Now, cool thing is, let me just point this out. When you do your financials, you basically start at the bottom and work your way up. So revenues and expenses on an adjusted trial balance will always be found here. So this right here will be your income statement. Now, the statement of equity then summarizes your stockholders' equity. So right here, these pieces plus net income. So once you do this, your net income will go onto your statement of equity. So statement of stockholders' equity. Once you have the statement of stockholders' equity, you'll have your final balances in the retained earnings and common stock. So from here up will be your balance sheet. So you have everything you need to create all your financials. You just have to summarize it. Once a summary is done, like the income statement, we don't need to show all of these accounts on this statement. We simply roll the product, the net income or net loss, into the statement of equity. And we'll see that here in just a moment. All right, so with that in mind, let's start at the bottom, work our way up. I'm going to split my screen again just to help out. So if you're working it on a screen, sometimes you have to split. It makes it a little bit easier. All right, so we're going to put our revenues. We only have one, so I'm just going to say, hey, my service revenue was $29,700. Now, keep in mind, financial statements, if there's two columns, it's just to make it pretty. There's no debit or credit on a financial statement. You can do it all in one line. Typically, we'll have two lines because we're reporting comparative years. So you'd have 23 and then 22 so that people could compare your years. But please, please, please note, on a financial statement, you will never report a debit or a credit because people in the real world do not understand debits and credits. Investors may not even understand debits and credits. They know you made revenue of $29,700. They don't need to know it's a credit. That's just accounting lingo there. All right. Then we want our expenses. Now, I'm going to cheat a little bit here. I'm going to copy and paste because I don't want to spend all day creating these. But you're just going to list all of your expenses here. So your salaries, your rent, your depreciation, and your overall supplies. Now, keep in mind again, why am I putting them in that side? It's just to align them to make them look neat, okay? Now, what we're going to do here is we're going to do total expenses, and we're going to go add up those expenses. So make sure you pause the video and figure out some of this as I go. But once you do that, you get $13,300 for your total expense. All right. Now notice total is over here. Again, you could put all this in one column. It'd be perfectly fine. I just want to show y'all what we're subtracting here to get our net income. Now the last thing is our net income, or it could be a loss. In this case, we have a net income because our revenues exceed our expenses. If your expenses exceed your revenues, you have a loss. All right, so you take $29,700 minus your expenses of $13,300, you end up with $16,400. All right, so that's our net income. Now, once we have an income statement, we can produce a statement of equity. Now, the statement of equity starts with our beginning balances in common stock, retained earnings. Now, be careful there. I'm going to pull my beginning balances from here, but that's not always the case. So your common stock, 10.4, is our beginning balance in this problem because we did not issue any additional stock. So our issuance was 0. Now, if you're a new company and you had nothing, you would start with 0 and then you would issue stock. Or you may have a starting point and issue stock. So you want to use your beginning balance of 10.4. If you had issued stock, you would need to go to your January 1 trial balance to see what that beginning balance was and then add your issuance. We didn't actually issue any in this problem, so it's 10.4. Now, net income and dividends only impact retained earnings, so we're going to leave those blank. So our common stock ends at $10,004. Now, retained earnings, again, we'll pull that from our beginning balance, but I know here that since I haven't closed my books, it is 10. If you had to fix that or recorded dividends straight to retained earnings during the period, that may be different. So pay attention to the problem you're working. Make sure you pull your January 1 balance there. Issuance of stock does not impact retained earnings. That only impacts common stock. Now here's the connection. Notice what we're going to do here. We're going to bring this net income, because we've already summarized revenues and expenses. We don't need to do it again. We're going to bring this net income and we're just going to bring it down to our stockholders' equity statement. So that way we don't have to re-show all of those accounts that we've already summarized. Then we're going to take away our dividends that we had, and that's going to give us our ending retained earnings balance. So notice, to find retained earnings, you bring your beginning balance, you add net income, you would subtract net loss, you subtract any dividends paid out, and that's going to give us our ending retained earnings balance. Now you may ask, does anything else impact it? It can. If we had a correction, that may impact, and we would add that up here after beginning. So we do beginning balance, and then we adjust for prior period corrections of errors, and then we have our adjusted beginning balance. Then we still do net income and dividends. So that's sort of the flow there. So if you're ever asked what's the formula for retained earnings, it's beginning plus income minus loss minus dividends gives you your ending, and that way you can calculate your ending balance and retained earnings. Now your total over here is just the sum across so that we can see what our total is going forward. Really easy and quickly, we're going to put that in there. So what's our total stockholders' equity? Well, at the end of the day, it should be $32,000. All right, once we have the stockholders' equity, now don't forget, I did forget, but let's go back. Justice League Internet, you do have your proper heading there. Some people are a little particular on that. Statement of stockholders' equity is also for a period of time. So for the year ended December 31st of 2023 here. That is not always, it doesn't have to be a year, it could be a month. All financial statements are dated for a period of time except the balance sheet, because the balance sheet is a snapshot. Balance sheets are only applicable for one day and one day only. All right, so it's like a photograph. You catch it at that moment. So let's bring down to the balance sheet. So again, before I get started, let's not forget our lovely header there. So Justice League Internet. And then notice this one's going to be dated differently. This is going to be a direct December 31st, 2023. Sometimes people will put as of in front of it or at. That's up to your individual, whoever your professor is teaching you this class. I just put December 31st, 2023 because it's a date and time, and that's it. Now, what goes on a balance sheet? Well, balance sheet is nothing less than the accounting equation. Assets equals liabilities plus equity. We're going to do just a plain balance sheet here. We are not going to do a classified. A classified balance sheet would split your assets and liabilities into current and non-current. In other words, current is anything that will be consumed within a year. Non-current is anything that lasts beyond a year from the balance sheet date. We're just going to do a basic balance sheet. So first, we're going to start with our assets. Again, just to save time, I'm going to cheat a little bit. I'm going to copy my assets down. If you need time to pause the video to type those in, that's fine. So what assets are we going to show? Well, all of our assets here are coming down with us. Now I'm going to move a little bit. Remember, this does not mean debit or credit. So I'm going to bring my accumulated depreciation and show that, hey, accumulated depreciation does go in the balance sheet section of the balance sheet. Excuse me, I just said balance sheet section of the balance sheet. Wow, that's a tongue twister. The asset section of the balance sheet. So you're going to go in and you're going to record your assets. You're going to show that depreciation, reducing your overall assets. Do not show it as a liability. A lot of people grab it as a liability. It's not. It's a contra asset, so it needs to go in your assets. So that's going to bring us to our total assets. Again, if you need a moment just to pause the video to catch up, that's fine. I'm trying to get through it and show you what all goes in here, so we're just copying and pasting the info. All right. So we go in, our total assets here are $43,100. So when we're done, the sum of our liabilities and equity should equal $43,100. If it doesn't, we've got an error. All right, so let's do our liabilities. Again, we're going to just list all our liabilities. We're not doing current versus long-term. That's a classified balance sheet. Plus all of our liabilities for this company, these three here would be current liabilities. So they're all current anyway. So we're going to paste in our accounts payable, salaries payable, and deferred revenue. And then we're going to grab their balances there. Notice I am putting them in this column because it's just to make it neat and organized so that I can get my totals. So my total liabilities for this company comes out to $11,100. The next thing you want to show is the stockholders' equity. Can't type today, that's okay. Now, stockholders' equity, we've already summarized a portion of stockholders' equity, so let me get rid of this. Notice on our statement of equity here, we've already summarized both the retained earnings and the common stock. So on our balance sheet, we're going to have a paid in capital section. We will show that common stock account. We're also going to have the retained earnings, just the final balance. Again, we don't need to show the detail behind retained earnings because we've already reported that in the income statement. So here's your connection. You're going to simply take these two balances and we're going to drag them down. Whee! And we're going to place them right here. Okay, we've already got the summary. We just need to put in our balances. So we got $10,400 for common stock and $21,600 for our retained earnings. So notice those relationships. The income flows into the statement of equity. Statement of equity, your final balances there will flow into your actual balance sheet. And then we get our total stockholders' equity. Go in here again. I can't type, so y'all bear with me. We see that if we sum those two accounts, it is indeed $32,000, which is what we report. So notice our total up here is 32. That comes down for 32. Now, that brings us to our last step. We have to prove a balance sheet does indeed balance. So we're going to go in and hit total liabilities plus, and stockholders equity here, and we add the two together. 32 plus 43 does indeed give us how much? 32 and 11 gives us indeed 43,100. I think I said 43. I said the answer. Whoops, that's okay though. All right, so you're going to go in, you're going to add those two. Let me fix my formatting. And you should see that your balance sheet is in balance. That's a good thing. All right. So we've created all of our financial statements here that we're going to do. We will not do a statement of cash flow. We just work on understanding investing, operating, and financing activities. Now, once that's done, we can do our closing entries. Now, what are closing entries? Well, closing entries get us ready for the new year. Notice, net income, so revenues, expenses, and dividends are part of retained earnings, the cumulative earnings. So before we start a new year, we need to move the balances. This is a relocation process. So closing is sort of a weird name. We're not getting rid of them. We're simply relocating them. We're going to relocate our income accounts, revenues, expenses, and our dividends, our red accounts, RED, revenues, expenses, dividends, into retained earnings. Why is that? Well, think about your paycheck. Do you want to be taxed on your life-to-date earnings or your annual earnings? Well, we're taxed on our annual earnings. So if you notice your pay stub, at the beginning of the new year, everything resets and your current and your year equals each other. Well, that's the same way for companies. We need to reset. We need to sort of get it ready so that we can see exactly what we earn in 1 year and not have it a full life-to-date earnings on our income statement. So those red accounts, revenues, expenses, and dividends, those balances at the end of the year after we produce financial statements and reported those to the street, after all that's done, we need to relocate those balances into retained earnings. That way, all of our revenues for the current year are just the current year's revenues. So if you go up here and look at our balances, notice our revenue account, for example, has a balance of $29,700. We need to start the new year over with a zero balance so that we can properly record just the revenues for that year. So to do that, we need to debit that account. Now, it doesn't go away. It just simply gets relocated into our retained earnings. So the easiest way to do this is note everything below retained earnings on our balance sheet, or on our trial balance, will get closed into retained earnings. They get relocated. And that way, all of these numbers for the next year only show 2024 information. It doesn't have 2023's information in there. So let's start the relocation process. There's 3 entries. 1, we close revenues. Follow the RED, the acronym, RED, revenues, expenses, dividends. Red accounts are closed. They're relocated to retained earnings at the end of the period. Now, this is only during the closing, so make sure you're doing closing entries when you do this. Close revenues. So look for all your revenues. There may be more than one. This problem only has one. Notice revenue has a credit balance of $29,700. To close it, to relocate it, we need to debit service revenue for that $29,700, and we need to relocate it to our retained earnings account. Okay, so this is nothing more than a relocation process. Witness protection. How's that? We're moving the information. We're protecting our witnesses to properly report for the new year. That's going to be $29,700. All right. Now, how's our income, our balance sheet impact? It's not. Okay. Income is not impacted. Why? Because we've already produced financial statements. So when you do closing entries, you will not impact any of your financial statements. You're like, but I'm reducing revenues. No, you're not. You've already reported this to the street, so your income statement's not impacted. All this is a relocation. So basically, within your equity, you're going up and down within your equity. So be very careful of that. You're not actually impacting your financial statement. So just ignore that piece. All right, next is close expenses. Notice we have 4 expenses here. So we're going to close those. They have debit balances. We need to credit the accounts to close them. So let's go in here and credit the accounts. And again, I'm going to copy and paste just to save time. By crediting the accounts, we're closing them out. And what are we going to debit? Well, we're going to debit retained earnings. Now, my apologies. I will put some. That's going to mess that up. So I'm going to abbreviate expense just so it doesn't mess up my format there. Sorry about that. All right. So get all of those. We're going to sit there and we're going to credit all the expenses to force them to zero. And we're going to move that balance, which was $13,300, I believe it was. We're going to move that $13,300 into our retained earnings, relocate it. Again, no impact to our financials. Why isn't there? Just to show there's no impact, okay? Now, you could put a plus and minus to equity, but we've already produced the financial statements. We've already reported them to the street, so we're not actually impacting the totals at all. All right, and the last thing is dividends. Dividends does have a debit balance, so that means we're going to credit our dividend account for the 48, and it also gets relocated to retained earnings. Now, your book and your professor may use income summary, and that's perfectly fine. If your class uses income summary, you would actually hit income summary instead of retained earnings. And then you would have one additional entry. So pay attention to that and follow what your class does. We close straight to retained earnings. Again, no impact there. All right. So that is it for the accounting process. Now, if you were to post these, what you would end up with is anything below our retained earnings account would have a zero balance in the post-closing trial balance. We're not really going to do that because it's so monotonous, but if you're an accounting major, you need to understand that process. If you're a business major, you do not. So we're not going to do the posting the closing entries or any of that. What you need to really understand is those do get reset, so that way we're only reporting annual revenues. And that's important for all business individuals to know out there. All right. Common errors, again, no cash in the adjusting entries. And then closing entries are meant to reduce retained earnings to zero. That is not true. We increase retained earnings. It's a permanent account. It will always have a balance. It is the accumulated earnings of the company for its life. So that's its revenues, expenses, and dividends. So if you look at Ford Motor, that retained earnings number is the cumulative earnings since Ford Motor, in theory, began operations. So that's all retained earnings is. All right, I hope this video has been beneficial and helpful. Y'all have a wonderful day.